Welcome to episode 1 of Health Further. I'm your co-host, Marcus Whitney, and alongside me is my partner.
I'm Vic Gatto.
And we are the co-founders of Jumpstart Health Investors. And Vic, what the hell are we doing here?
I'm excited to get back on the horse and start going again.
Yeah,
we haven't done Health Further for a long time.
So really quickly, we don't want to belabor the point, but we're both healthcare VCs. We've been working together about 15 years, but in the healthcare space specifically, coming up on 9 or so years, right?
Yeah.
Based here in Nashville, Tennessee. A little bit more about your background.
Yeah, so I did a startup in the 90s, jumped over to be a VC in 2000, and was at a couple other venture firms before you and I decided to start our own VC fund. And it's been a lot of fun. There's a lot of change in healthcare right now, so
yeah,
fun place to be.
And my background, self-taught technologist, built digital marketing companies kind of through the early 2000s. Made this switch into an entrepreneur around 2007 when we had the big technology evolution of iPhone, social networks, and the cloud. And then you and I partnered. We did the accelerator version of Jumpstart Foundry, and we've been at it ever since, right? You know, today I'm running one of our funds, Jumpstart Nova, that's investing in Black-founded and led healthcare companies. You're running Jumpstart Capital.
Right. And then together we started our pre-seed fund, which now is I think of it as a feeder system for our funds.
Yeah, and has across our whole platform, we've got over 150 companies that we've invested in, probably invested in another 40 before the end of the year, maybe 50 in aggregate with the companies you and I are going to invest in our funds. So so a little bit about Health Further. So we just told you about Jumpstart.
Yeah, right.
Health Further was a conference that Vic and I started in 2015, right?
Right.
We did the first one here in Nashville, and we did it because we felt that there was a void in the market, specifically Nashville, right, as a hub of healthcare. We thought there was a void in the market for healthcare innovation conferences, and so we got a bunch of partners in terms of like local companies. Parallon was the anchor sponsor. Healthcare Council was a big supporter of what we were doing. Haley Hovius was the CEO at the time, and we threw a pretty good event. Had like 750 people there.
Yeah, and it was I think it was kind of our way to have an excuse to call our friends and say, come join in with us. Let's learn together about. We really knew at that point early stage innovation in healthcare.
Yeah.
But we're trying to learn about how all of these bigger systems interacted.
Yeah. And I think one thing that we had as a value kind of right from the very beginning, right, was that we're early stage investors, and I didn't even have a background in healthcare, right? So I mean, on one side, I wanted to grow my network and get smarter about healthcare, but on the other side, we also thought like healthcare is a little insular and, could use to meet people outside of the industry. And so I think right from the very beginning, we were focused on bringing in people who were not healthcare proper, right? But were doing things that were relevant and relatively innovative in the healthcare space. I remember we closed out with Chris Dancy, I remember, in year one.
Even inside healthcare, it's pretty siloed. I mean, you have health systems all talking to each other, you have payers, and even within that, you might have a specialty. Cardiac talks, and then, I don't know, there's different groups, but they don't really talk to each other or, heaven forbid, talk to anyone on the outside that might have new ideas.
Yeah, like I do keynote speaking, and it is amazing how many different trade organizations there are in healthcare for all of the different segments, right?
Niches.
Yeah, exactly.
Right.
So we, right from the very beginning, we wanted to bring in quote unquote outsiders. So we did the conference for 4 years, and by the end, I mean, we had Greg Glassman, who's the founder of CrossFit, as a speaker. We had a whole blockchain segment in our last year that was pretty great. And we were always just focused on how do we just make a bigger tent, right, for conversations around healthcare. It's the biggest industry by GDP. It touches every last one of us. There's no reason for conversations about the future of healthcare to be just conversations that happen within the industry.
Yeah, that's right. And I think that we have always taken a broader view of health, right? So Greg Glassman's a good example. I mean, health and wellness includes exercise and includes food and diet, as well as a procedure you might get done with a surgery in an OR. I think it's all intertwined, and it affects one another. But often healthcare is very focused at the delivering care to a patient who might be anesthetized on the table.
Yeah. Yeah. And I think also even from a political perspective, like we had, I think at the same conference, the national president for Planned Parenthood and also Art Laffer. Right. Right. And I think that was always sort of a core value of ours as well is, look, America has a variety of views and healthcare is important to all of us. And we need to try to capture all those views into one conversation. Yeah.
And I think with those personalities, and it's a perspective of curiosity and trying to learn. And I can learn something from everyone from what side of the aisle they're on.
Yeah, exactly. So then it kind of gets to like why we're doing this podcast, because we did that conference. That was fun and also hard. We did it for 4 years. We stopped in 2018 to really completely focus on our venture business.
Yeah. I never want to serve lunch to 2500 guests again.
No, I'm done with that. Health and Vive and all of you all. God bless you. That's right.
Eat your lunch.
God bless you. Yeah. But I think also we recently started just having these feelings based on our daily and weekly conversations that the rate of change and the macro environment are just so dynamic right now. And it just does not feel like the current conversation that is largely dictated by some very successful conferences can effectively keep up with it. Yeah.
Doing 1-2 conferences a year is not a pace where you can cover this stuff.
No, it's happening way too quickly. So I think we both felt that a podcast would be a good model for how we might have these conversations, and doing it on a weekly basis where we can touch on sort of evergreen themes, but also touch on things that are happening that very week and try to connect the dots between those things, and also have conversations that we just, quite frankly, do not hear anywhere. We listen to a variety of podcasts, most of which are not healthcare podcasts, to be honest. And I think
I've been searching for this podcast that we're about to put on.
I agree.
And I can't find it. Well, healthcare is somewhat insulated from the rest of the world. It's not fully insulated.
No.
And so one of the things that you and I spend a lot of time on is trying to understand different parts of our world and what's happening in those areas and how might they affect our business, honestly.
Right.
And then how is that impacted by healthcare?
Exactly. So I sent you this tweet when it came out. Let's see, April 25th, at Jay Parkinson, Jay Parkinson, MD, MPH. He put this tweet out, and I was just like, yes, I totally feel this right here. So he says, digital health conferences are for geeks like me. It's the same folks attending all of them. So if the audience is the same, why are the speakers and panelists all the same? It's insulting to attendees, and it's an admission that there's not enough interestingness in the space.
That's right. I mean, we go to the conferences. I'll keep going to them, but often the networking events are where I actually learn something. He's exactly right. The speakers are very predictable, and the format is not right. And I think that's why I don't want to do a conference again. The format is challenging.
Yeah. And I think because we ran a conference, we know like conferences have massive fixed costs. Like the minute you decide you're going to do it and you sign the contract with whatever venue, you're in the hole, right? So, you start figuring, how do I...
You got to sell tickets and get sponsors.
You got to sell tickets and get sponsors, right? And, the same speakers that are known entities that have been successful at selling tickets to previous events sound pretty good when you got to make a profit, right? So we understand, and it's not something like we're mad at because we've been there. We've done it. It's really, really hard. But we think a podcast is a really liberating format where there's no expense here. I mean, literally, we invested in the studio and that's it.
Yeah. I mean, we're in your office.
Yes.
And there's a couple $1,000s of fixed costs that's been spent.
Yes, done.
And now we get to talk to each other, debate things, agree on things, bring in guests that might have a different point of view. I think it's going to be fun.
So, all right, let's start with our first topic, which is it feels like it's been the topic in our lives for the last 9 months now, which is crazy. Maybe even more than 9 months, probably from last July.
Yeah, I think it's more.
Right, which is the Fed and the rising Fed fund rate. So March 2nd, Fed's Powell says still appropriate to raise interest rates by 25 basis points in March. So this is not really surprising. I think most people knew that there was going to be another increase. We weren't quite ready to have a full pivot yet.
Yeah.
And 25 basis points is a drop down from the last step up right after SVB, which was 50 basis points. And the ones previous to that were even larger.
I don't know if this is the right clip, but just yesterday he raised it again on May. What's the date today? May whatever.
Yeah.
And so he's continued to raise it.
Yeah.
And that's exactly right. It's we were finished with the need to raise, in my opinion, 6 months ago. And all the things that I think are forward-looking, it's very clear that the economy has been slowed, and yet they raised again yesterday.
Yeah. Yeah, and so we wanted to put this chart up on the screen, but for those of you who are listening, we have the Fed fund effective rate chart here from Fred, and really the only thing to really look at is two things. One, that the rate was 0 for most of the 2010s, with a little bump up from 2016, went right back down to 0 in 2020, and then the rate of change going from 0 to north of 4, but now we know we're north of 5. Yeah. This rate of change is almost vertical. It's almost a straight line up.
Fed can't move any faster.
No.
It's impossible to move any faster.
Yeah. And a lot of stuff got broken. I mean, obviously the biggest thing has been the regional banking circuit. We've had the second largest bank failure happened this week.
Monday.
This week.
Yeah.
First Republic. And that wasn't really a surprise. I mean, the writing was on the wall for First Republic for weeks now, 6 weeks. I mean, they were next in line after SVB fell.
But the Fed should not be breaking banks. I don't know the exact mandate, but I don't think that's in it.
All right, but okay. I'm not sure that the Fed was necessarily trying to specifically break banks.
No, I agree.
Right.
They wanted to tame inflation.
Yes.
But when they raise the main rate for our entire economy at that pace, something is likely to break. It happened to be regional banks, but they could not have predicted that. But you could have predicted that various things would be under pressure.
Yeah. I mean, they're raising the rate to break things.
Yes.
They're specifically trying to break things. The idea that they were going to break the regional banks, I don't think was what they had in mind.
That was not their goal.
Right.
But it was likely, when you said they were trying to break things, they're trying to break the strength of the economy or cut down the growth rate.
Yeah, they're trying to cut the growth rate. They're trying to slow business down. They're trying to slow the consumer down. They're trying to get employment to something that feels more reasonable, which is kind of the weirdest thing to say in the world.
It's ridiculous because the participation rate is the problem, not the unemployment rate.
That's right.
But the real issue is Jerome Powell. I mean, I'm sure he's a nice person. He has like a big machete and no fine tools.
Yes.
So he only has basically one tool he can cut your leg off, and or he could put the gasoline on it and ramp things up. And unfortunately, he needs better tools.
So how did this affect us? So first, I just want to tell like a little personal story. So the week that SVB happened, I remember it was like Wednesday when the stories started to kind of roll.
Starting to hear rumors.
Yeah, you're starting to hear rumors, right? And I remember sending a story to you and Doug on Slack. Doug is our CEO. So I remember sending like a story to the both of you on Slack, like, hey, we probably need to like check into this. I remember that, right?
Yeah.
And by Friday, it was 4-alarm fire. I mean, the world was totally crumbling.
I mean, from Wednesday to Friday, they shuttered the bank.
Yeah.
You couldn't get your money out.
Yeah. It was insane how fast that happened. It's not a typical thing for venture firms to, as part of its due diligence, ask a company where they bank.
It used to be.
Yeah, it didn't used to be, exactly.
Right.
And I didn't know that 3 out of our 9 companies banked at Silicon Valley Bank. And so from Friday morning to Sunday evening, we were on call, trying to figure out what we were going to do. Yeah.
I mean, we were lucky. Out of our 8, we only had 1. We had 2, but 1 was under the 250 level.
Okay.
And we had 1 that was over. But our fund itself wasn't at Silicon Valley Bank.
That's right.
A lot of VCs that we're friends with, they had their portfolio there. They had their personal debt there. Their funds that a couple guys I know had their mortgage with SVB.
Sure.
And it was just chaos for the weekend.
Yeah. It was insane. And then it wasn't, because Yellen and Powell got together and decided there's going to be 100% backstop. Fine. Which is actually, that's a story we're not going to get into today, but we really should in a future episode talk about the implications of that whole credit facility that's been created and how much capital has been placed back to the Fed in that discount window and just what that really means.
Yeah. I mean, this is an ongoing story. So we will come back to credit markets and banking markets. What are regional banks? What is the business model for a regional bank?
Yeah.
We as startup funders, we can't put every company at the 4 big national banks.
No way.
We need other service providers.
Regional banks have been a critical part of our story.
Yes.
Growing, like critical from day one.
Yeah.
They've been partners. They've been LPs. They've been our treasury management partners. They've been our line of credit partners. I mean,
yes, we have multiple banks that are LPs of ours and not just the big banks.
Yeah.
We have great partners at regional banks that do good work, but they have to have a business model that's viable.
Yeah. And so that is now in question, which leads to the next chart I want to bring up here. So this is a chart from PitchBook and the MVCA. They always work on a quarterly thing called the Venture Monitor. And it basically, tallies up all the capital that has been deployed, that's been raised, et cetera, in the venture capital industry, and kind of lets you know, like, is the VC industry going up or down, basically.
Yeah.
And in this chart, for those of you who are not watching, there was a huge spike in VC deals that were done quarter over quarter from Q4 to Q1. This is 2020 to 2021. So
basically doubled.
During the pandemic, after all the capital was deployed by the Fed in stimulus efforts. So it's PPP, this is idle, this is stimmy checks.
Pouring gasoline on
That's
it.
right.
Yeah.
That's right. It's basically doubled, right? From Q4 of 2020 to Q4 of 2021, it doubled. Right, like the deal count doubled.
Yes. 50 billion to 100 billion per quarter.
So of course that was not real.
It was not real. There were not double the number of worthy companies at double the valuation. That wasn't real.
Yeah,
it was fun, but it wasn't real.
Well, I didn't find it to be fun because I was like losing deals left and right because
it's hard to put money
term sheets were flying around.
Yeah.
Like founders were like, listen, I got 3 term sheets, so like buy. It was awful.
I raised money on Twitter.
Right. But now, like coming into 2022, and you can really see Q3 as the Fed starts to turn up the Fed fund rate machine. You can see we're going right back down to the Q4 2020 levels. That's basically, you could just draw a straight line and see, with all the froth that came in during the pandemic for 6 straight quarters, it just flatlined and fell right back down to its normal levels.
Yes, that's right. And unfortunately, that is going to take a while to unwind.
Yes.
Right? Because we have a lot of companies that were financed in 2021. Not long ago, right? So if you raised money we raised enough money for 2 years of operations, and we're going to come back to market in 2023, you have hit all of your operating metrics. You've hit it out of the park. Maybe you're ahead on some things,
right?
And now you come back to market, and there's half as much capital.
Yeah, and you you based your valuation and your exit expectations and all these other things on this fairyland. Like this was
the
never,
last round was done, and now you have to do a down round, even though you've outperformed.
Yeah. So there's a whole lot of and one other thing we should talk about is how many new first funds were raised, like Jumpstart Nova. Let's keep it real. Jumpstart Nova closed the entire fund in Q4 of 2021. So right in the middle, at the highest peak of this ridiculousness, that's when we closed.
Actually, better to be there than in 2020.
I agree.
Because you would have
deployed,
wasted all the money.
Yeah, it would have been deployed in this terrible vintage. So now it's all sort of dropped out, and everyone is looking at it and acting as if it's like winter, but in reality, it's just going back to where things were normally from 2018.
Yeah,
right.
That's right. There's a steady state of companies that create something innovative and new that adds value,
right?
That need to be financed,
right?
And that will continue. The problem is that there's half the market that is not going to be financed, and there's a lot of good people in those companies that did everything they were supposed to do, and yet it's going to fail.
Yep.
And that there's going to be a survival of the fittest shaking out that is, I mean, whether it's fair or not fair, just is. There's, so half the companies that come to market this year will not raise money, and those companies will go out of business or they'll sell at fire sale rates. And so it's going to be really challenging if you are a founder or in a management team of a small venture-backed company. It's twice as hard to raise capital, and there's so many more other companies that are worthy competing with you. It's going to be really, really difficult.
So let's just talk about the survival of the fittest bit, because that's not just for VC-backed companies or PE-backed companies. It's also for the public market. In fact, the public market probably
really leads.
Yeah, they lead the way with this, right? So, hot off the presses today, Shopify doesn't really have anything to do with healthcare, but it's important because this is, one of the best performing high growth tech stocks, has been heralded as just an excellently operated company, right?
Great company,
right? Today they announced they are letting go 20% of their staff and selling their entire logistics business. Now we've been seeing like this steady 7% number. Like that's been kind of the number, the safe number. I think Meta said it. I think Amazon said it. I think Spotify said it.
Right.
7%.
That's the symbolic
that's right.
BS thing. Let's cut some staff to make Wall Street happy.
Yeah. And 7% is not nothing, right?
Yeah,
I mean, that's
50,000 employees is a lot of people.
It's a lot of jobs, right? Shopify cut 20% of their workforce, selling off their entire logistics business, which I remember during the pandemic in the e-commerce frenzy when everyone thought it was like we were never going back into a store.
Yeah, it was valuable.
Oh my God.
Right.
I mean, I remember seeing their whole, story and online conference about this logistics center, right? And how they were like taking on Amazon effectively, right? For the individual e-commerce retailer, right? The stock jumped from 47.50 to 57.50 on this news.
Yeah. And to me, it's about focus, right? So Flexport is better at logistics than Shopify, period. I mean, they were doing, it was an okay service. They did a good job, but they're not Flexport. And I have been telling this to my portfolio companies. I think every startup, every public company, every company in the world, you have to really understand what are you able to beat every competitor in the world at. Shopify is incredible at their core. Their core is not logistics. And so instead of doing the safe but follow the herd thing of cut 7%, they cut an entire aspect of their business. I mean, this came out an hour ago.
Right.
And so it's I haven't looked at all the details, but I think they got rid of the entire fulfillment, logistics, operations, and sold it to Flexport. And then in return, Flexport gave them a deal to provide those services.
Of course.
That's a much more aggressive and smarter and highly focused thing. It allows then the management team to say, we're going to let Flexport do that. We're going to be really good at empowering small businesses to sell what they want to sell online, because that's what Shopify, that's how they win. I think about it as like there are things that you have to do to be in the game at all. And then there are things that win the game. And operations, logistics is, you have to deliver that to your customers, but it's not a differentiator that's going to really win.
Right.
And so it's brilliant. They are going to get to focus their management time, energy, capital, attention on what is really a game changer for them.
Yeah. And look, I mean, in the VC industry, I think as partners, we have been trying to encourage our companies to follow suit with what they're seeing in the public markets. Unfortunately, you've got to lower the burn because guess what? The capital has dropped in half in the market. So if you were depending on growing and just all your growth was going to make up for the fact that you're burning an unbelievable amount of capital, that's over. That's over.
And if you are investing money to win in your core focus area and you actually can be world-class in that, then okay. Everything else is on the chopping block and needs to be subject for letting someone else do it.
Yeah.
I've been trying to get my CEOs to understand this valuation new era that we're in. And another great company that I've been using all the time is Stripe.
Mm-hmm.
So we both have portfolio companies. I love my portfolio companies. They do great work and they ain't Stripe. Right? Stripe is maybe the best startup in the history of startups.
That's crazy.
It's incredible. It generates huge amounts of cash, and their valuation got cut in half.
Yes.
And so XYZ company, I'm not going to name any names, but every company out there,
yes,
you ain't Stripe.
No.
And so your valuation starts at 50%.
Yes.
And then if you are as good as Stripe, it's questionable. You should be at 50% of what you were last year.
Yes.
And that's really hard for people to get emotionally okay with.
Well, it's more than that, right? I mean, people, while that capital was being thrown out into the market, people bought in at those 2x prices. So it's not just their own emotions. It's the idea that they have to go back to all these other investors and tell them, hey, your dollar that you put in my company is now worth 50 cents.
Right.
That's hard.
And by the way, I need you to put more money in.
Yeah, exactly.
and in my experience, which, we've been working on this over the last few months, it's going to continue.
Yeah.
The CEO and management teams take a while to come around, but they come around. At the end of the day, they need to raise money.
Right.
And they have their dream they're trying to build. And so they have to figure it out, right? But the investors are not that way.
Right.
They're much more egocentric. They're much more proud of their track record and paper results for a long time. And it's not their dream. So they can stand in the way and just say, well, I'm not willing to take a write down. And there's going to be a lot of companies that could raise money, but they don't because they're trying to raise money at ridiculous, what I think today are ridiculous prices.
Yep. Yeah, so let's now talk about something maybe a little bit more exciting. Axios had the scoop on this company Healthy.io that raised $50 million in a Series D. So that's good, right?
Yeah, they're one of the winners, right? They came out today, raised a bunch of money, and successfully.
Yeah, so smartphone-based kidney and wound testing company. So I like that. That's like a real digital health business.
Yep. It's a huge market.
Huge market. And I think, the thing I want to just point out here is that who are the investors? Well, the investors who led this round, Schusterman Family Investments, who were the existing partners, Cigna, Blue Cross of Idaho, right? So we're still seeing payers leading the way in the venture space right now. We're seeing payers continuing to innovate in the services space, in the data collection space, in the digital health space broadly.
Yeah, I mean, the payers are leading the way. They're moving into providing care. This is a good example.
Yep.
They're doing it in ancillary, kind of around the edges. They're not building ORs, but this is a good example of a winner, right? They're very focused in chronic kidney disease. It's a huge problem. The current treatments are really hard on patients. They're super expensive, and the outcomes are not that good.
Yes.
And so they have a very effective test. It's a lot to the home, and payers are leaning in. And I think they're going to be rewarded. Whether this deal is super successful or not, the idea that payers are leaning in and learning and supporting innovation, collaborating with one another, which I think is critical, and also finding innovations that can make a difference, that's really important. And I think they deserve to be rewarded.
Vic, did you hear the news about the big payer merger that happened?
The big payer merger? No, I don't think so.
Yeah, Kaiser and Geisinger.
Yes, right. That's a good point. So the best health system merger in the last 2 years is, in fact, a payer merger. That's good. I like that. Yeah, I mean, the health systems are way behind. So I don't see health systems investing at the same pace or really to learn and get exposure and get sort of strategic partnerships lined up, nor do they collaborate with each other in the same way that payers do, except for ones that also have a big payer system on the back end. And we should talk about why that is. I'm not sure I fully understand why that is, but there's a convergence between health systems used to be only providing care and then submitting bills to either CMS managed by payers or to commercial payers. And that is shifting now to where payers are providing care. I think United Health Group employs more docs than anyone else. And they also are investing in innovation and leaning into new technology and new business models. And health systems that have experience in the payer world have aligned incentives, already are converged. This is a great merger. I think whatever the new name is,
Risant Health,
is going to be a really important player. And they're going to work on value-based care in a way that, probably is going to be better than payers because they understand the delivery of care in a way that they have ORs, right? They understand the full continuum where not every payer does. But that's the minority of health systems. Most of them haven't really done much on the payer side.
Yeah, no, I agree with you. I actually was lucky enough to get out to Scranton area and see Geisinger and be on the campus. It's a pretty old school, true community hospital in terms of like the story and the name and the communities that they serve. To me, this is a really big deal. This is a really, really big deal. Geisinger has, at least as long as I've been in the space, they've always been a thought leader around innovation. David Feinberg gets, I think, a lot of the credit for that. But man, the idea that they're merging with Kaiser, a new name is now being, created. This to me it's a big deal. It's a big deal because so much of hospitals, especially community hospitals, there's so much emotion built into it, right? The idea that you would make this kind of change is just not insignificant at all. It feels to me like a sign of things to come. These are two of the most well-respected nonprofit hospitals, I think, because of their value-based care execution that they've done over the last 10 years in the case of Geisinger and much longer in the case of Kaiser. And my experience, even among the health systems that we work with, is the ones that have a health plan, they have a little bit more. They're a little bit more leaned in on innovation, especially as it pertains to things that are going to lower the cost of care.
Well, they see how it can affect their bonuses and their results. But I think what I think is interesting that we haven't touched on yet is we're talking now about a West Coast dominant integrated system with a payer acquiring a Scranton-based Middle America. I mean, Scranton is, I guess, East Coast, but it's pretty Middle America.
Yeah, it's Northeast, but it's also like it's I struggle to call it rural, but it's out there. Yeah. I mean, like you land on a plane and then you got to take a car.
It's not Philly.
No, it's not Philly. It's definitely not Philly.
So when we're in Nashville, right? So forever I've thought that Middle America, it's where all the sick people are. It's where all the chronic disease is. It's where a lot of innovation bubbles up from Middle America. Unlike the tech industry where innovation happens at research institutions like on the coast, Middle America is where all the really chronically sick folks are. And the idea that Kaiser is now combining with Geisinger, who really understands that they're not completely rural, but they understand Middle America. They understand that ethos of, I had my grandfather was born in this hospital. Then I was born here. Then my son was born here. We've been coming to Geisinger forever. And to change the brand is a huge thing.
That's a huge thing.
But I think they also will, we don't know how they're going to do it, but I believe they understand that ethos and caring for the community in a way that it's hard to believe that California sort of ethos will be the same. So that's why the combination, I think, was really interesting.
All right, let's keep talking about providers, and maybe not so much of the value-based care variety, but maybe just more of the fee-for-service variety.
Yeah.
You pulled together some really cool data points right on the heels of a very good quarter for HCA, which I think really made people look up and realize, hey, maybe the labor issues aren't as durable as we thought. Maybe, they're starting to all turn the corner. So you pulled together some good data points.
Yeah. So, I think we started off with the Fed and financial markets and negative impact broadly they're having on the economy, right? And so that is hard for a lot of sectors. But for the healthcare system, for the providers, they have had a challenge in finding staff, finding workers. The rates to pay people have been growing incredibly fast, and of course their reimbursement rates are locked in, largely regulated, and so they were kind of stuck. The incredible amount of demand, and so it's just a different business model. Most businesses like Shopify, they're trying to find customers, and they can easily service it.
Right.
Health systems largely have been the opposite. A lot of people need help, but they can't find nurses. They can't find nurse assistants. They can't find transport people. They can't find environmental services. There is a shortage of doctors, but when you go down the licensure level, it's been really hard. Mm-hmm. And so the struggling economy and the workforce, people losing jobs, has an inverse relationship to health systems. So HCA is a perfect example. They're one of the best operated health systems in the country.
Without a question.
I wish they would lean into innovation a little more, but they run their health systems incredibly well. And so they have already turned the corner and are able to attract workers and get back to positive earnings growth, which is you've seen in the stock market. But we have a slide from Kaufman Hall. It's kind of a depressing slide, right? So you see from April 22 until March 23, negative operating margins across the board.
Right.
And this is due to the very expensive labor force. It's about 80% of the total cost is labor. But the interesting thing is just recently, the last data point, it has gone to zero. So across, of course, HCA is better than that. But across the average of health systems nationwide, Kaufman Hall does a good job collecting information from health systems all over, all different sizes. You aggregate all of them together. Some run incredibly well, some run not so well. Now the operating margin has gone to zero, which is at least viable, right? Like when the entire industry is at negative 3%, negative 1%, negative 1.5%, you're losing money overall. That's not sustainable. Zero as an average is, you'd like it to be making a little money, but an average across all the ones that are, some are not well run, some are well run, the average probably is close to zero. So I was excited to see the health systems kind of come back, mostly because I'd like them to stop hiding under the bed and crying about how they can't survive and maybe lean into innovation, find a way to deliver the same care with less people or, maybe deliver better care with less people. And this seems like maybe we're on the right trajectory.
Yeah, it's certainly tough to think about innovation when your operating margin is negative 3%, right?
Yeah.
It's just very, very hard. And I know, it was public, so it's not just something that we have access to, but the losses that landed the back half of 22 were
huge.
They were
multiple
massive,
billions of dollars in losses.
Yes.
At many health systems.
And at some of the biggest, nonprofits, right? And so, this is welcome news because I think it means there can be a little bit of a reset and we can start to get to that innovation. I believe that the leaders of these health systems, know that innovation's an imperative, right? I mean, given everything that's going on in the world right now, I don't see how you could say we're out of that negative 3% operating margin. We're good now. We can just coast.
We're at zero.
Yeah, we can coast. Right. I don't believe that's the case, but yeah, I mean, wow, that's what a chart.
Yeah, so it's welcome news that they are hopefully on the road to recovery. And listen, every person can't go to an HCA hospital. Right? So we need the overall market to be viable as a society.
No question.
And I don't think there's any money in Congress to sort of throw money at health systems. And so they have to be able to work with the reimbursement they have.
Yes.
And as we talked about earlier, they have to catch up to the payers.
Yep. Agree. All right. Let's go through a couple more of these.
Where's this coming from? So there's a lot of pent up demand from COVID. So this slide is a kind of a proxy for cancer.
From our friends at Hedgeye.
Yeah, from our right. Hedgeye gives us incredible insight into the macro economy and the healthcare economy.
Yeah. I mean, this episode, we don't really have like any sponsors, although we will in the future. But, a little plug, you should definitely go buy like Health Policy Pro. If you want to like know what's actually going on, it's not that expensive. Just go to hedgeye.com.
Yeah.
It's awesome.
It's incredible. So
it's awesome.
This is one of, I think, 120 slides that they put out weekly.
Yeah.
And so it's a proxy for cancer patients coming into health systems nationwide. So Natera is the leading genetic testing cancer service. And so if we had cancer, we show up at a health system, one of the first things they do is do a genetic screen on your tumor to be able to inform the chemotherapy treatment or the they want to understand how to treat it. And so you see after COVID, it's just been through the roof as far as people now getting screened. And then the more screenings that happen, the more you realize that, gosh, I have cancer. And so there is huge pent up demand for health systems if they can find the employees at reasonable rates. So let's go to the next one.
Okay.
Because this is from Hedgeye as well. It's the year-over-year kind of change in earnings. Mm-hmm. And we want our healthcare workers to have an appropriate kind of inflation-adjusted standard of living. So that they should get 2%, 3% a year, but 8%, 7-8% is just not going to work. Reimbursement is growing at 2 to 3%.
Yeah.
And so labor
also
force can't grow that fast.
And also like only gets negotiated once a year.
Right. Yes.
So, when you have this kind of step change in the year over year, average hourly earnings.
They can't catch up.
Yeah. I mean, within half year windows, like that's not viable.
80% of your cost structure is growing
labor
at double the revenue rate.
Right.
That doesn't work.
No.
Right. That's why they had losses. So anyway, it's good to see this coming down. I think these things combined, Kaufman is so backward looking that these are trending data. And so it makes me comfortable that it's not a one-off, something happened randomly. Right. It's going to be sustainable.
Yeah. Yeah. That is good news. All right, we're going to wrap up the healthcare segment and I guess get into our technology segment. It's impossible to not talk about AI right now. It's just, I was a technologist for about 10 years, and I remember I spent most of my career building web applications and like building out servers, taking them to the data center and all that kind of stuff. And I remember 2007 being the year when I had to make the decision, am I going to basically relearn everything I know, or am I just going to shift into management and entrepreneurship? And I decided to shift into management and entrepreneurship because between the iPhone coming out, social media, remember I was in an email marketing company, so social media coming out, and the cloud, like every key skill that I had, well, I had the LAMP skill, but the open source software skill. But every key skill that I had, except for open source software, was like obliterated in 12 months, right? So I've already been through this kind of like value destruction cycle as a technologist.
Yeah, and you mentioned it in the intro, but that's when Jumpstart started.
Yeah.
But when you decided, I want to lean into learn about entrepreneurship and how do I put these things together and how do I sort of bring in teams of people, that's why Jumpstart started. Because that opportunity, you saw the opportunity maybe at South by or somewhere, and came back to Nashville like ready to go.
Yeah, it was 2007 South by.
Yeah, right.
I'll never forget it. So, for me, because I saw that up front, there honestly has not been a lot of like truly exciting stuff that I've seen or things that I felt like, wow, this is really going to change everything as a former technologist, right? Obviously until now. Yeah. This is so incredibly disruptive, and the rate of change is happening so fast.
Yeah.
That it's too fast to wrap a narrative around it, which means it's not going to go well for many, many humans, right? Because we learn through storytelling, and you can't really wrap a story around something moving this quickly. So it's a big deal, and I mean,
you and I are both kind of information education junkies. We have tons of podcasts and things, and
right.
It's changing daily.
Totally.
So I mean,
it's changing so much that whereas before, I feel like you and I would basically be at the same place when we were listening to podcasts, but now it's almost like we need to split the duty. Like you need to listen to certain ones, and I need to listen to certain ones because the rate of change is happening so quick. I don't think we can individually keep up with it. I don't feel like I can keep up with it anymore.
Yeah, and I'm an optimist in general, right? So I'm a tech optimist. When all of those changes with the iPhone came off, I was super excited. So like when you were interested in it, I was interested in it. I mean, we bonded over like this is going to change everything.
But it was slow.
But it was slow moving. It was slow in the terms of like between 2007 and 2014. There were impactful things, but the basic economy, people's careers didn't change.
Right.
And it's not like that now. So I'm still optimistic, but it's 80% optimistic and 20% like it's going really quickly.
Yeah. So one of the things that I said to you earlier was that as we were talking about, different jobs, economic dislocation of AI and all that kind of stuff. One of the things I mentioned is that right now, ChatGPT is better than an MBA intern.
Yes.
Like right now, with all of its warts, all of its issues, the data set's only from 2021. So it's got a ton of limitations. Yeah. It lies pretty often, actually. Like if it doesn't actually have the answer, it won't tell you it doesn't have the answer.
It doesn't distinguish.
It doesn't distinguish. It doesn't know how to do that. Right?
I don't think it distinguishes between past events that are historical fact and future events that it's predicting.
Yeah.
You can't distinguish that.
Right. So it's got all these limitations, right?
But despite that, it's better than an MBA fresh grad joining our company.
It's insane.
And it's better at every domain.
Yes.
Simultaneously.
Yes.
And so an MBA would be good at business, finance, maybe they specialize in marketing or something, but they'd have one of those.
Right.
And now it's MBA level at everything.
Yeah.
Now, it's not I'm 52. I've been a venture capitalist for 23 years. It's not as good at writing a term sheet and thinking about the structure as I am, but it's as good as I was when I got out of business school.
Yeah. Yeah.
And it is changing quickly. Right?
Yes.
So the difference from GPT-3 to 3.5 to 4 was an exponential difference.
Right.
And the really interesting thing is they added more data, but they started having humans train it. And the pace at which it learns is incredible.
So a couple things. So one, I think there's going to be a massive change in how healthcare innovation is delivered, right? And the cost at which you deliver healthcare innovation. There was a company during the frothy times, the 2021 frothy times, that raised $1 billion over the course of that year for AI. And this was all sort of the generative AI reveal, right?
Yeah, pre-Transformers.
Pre-Transformers, it was pre-Transformers. And so, when
that business today would be badass.
Except like
you wouldn't need $1 billion.
Right, I mean,
right.
I think that's kind of the point, right? Yeah, I think that's kind of the point. Is at that. I mean, that's just how fast this has gone. It was reasonable to a group of very, very good venture capitalists and private equity firms. It was reasonable to put $1 billion into the idea that you were going to be able to develop AI. You would never do that in May of 2023.
You couldn't spend the money.
No. Where would you spend the money? Right? I mean, it's crazy. We've already seen Stanford take, OpenAI, create a llama, basically, totally clone it for like almost no money. So we already know like this code is open source. Anyone can grab it. Anyone can do anything with it. And we don't have any regulatory environment to kind of tell us what the limits are on it. But you don't need $1 billion to do it. You know that.
Yeah, and the regulators cannot keep up. There's no chance.
No.
I can't keep up with it. But I think we should
They couldn't keep up with social media.
Right. Yeah, there's not a chance they're going to be able to keep up with it. And but I want to take a minute to talk about the difference between what ChatGPT has today.
Yep.
And then what it will be when it starts taking action in the world. So the difference between an oracle and agent.
And an agent, yeah.
Right. So today it's an oracle, meaning it has read everything on the internet and transformed it into something that no human understands, but it understands to be able to give reasonably good answers to any question you ask it.
Hold on, just really quickly. If you're wondering why oracles and agents feels familiar and you've seen The Matrix, that's why. Because there's an oracle and there's a bunch of agents in the Matrix. Because that's where this is headed, people. Okay, back to you, Vic.
Yes, and I want to point out that technology, including oracle and agents, can be used for good or evil.
That's right.
So agents
just like in The Matrix.
Yes. There happened to be a good oracle.
Yes. And good agents.
Yes. Yeah. Okay. So we have oracles today.
Yes.
ChatGPT is the best known, but there's 5 or 6, and I think they're going to be commodities.
And by the way, let's just say, ChatGPT is an oracle, based on GPT-4 or whatever.
Yeah.
But Google has an oracle.
Yes.
Amazon has an oracle.
Yes.
Right. So
Anthropic.
Yeah.
Stability.
Right. Exactly.
There's at least 5 or 6 that we could name today.
Right.
And you only need that many.
Yes.
Right? They're all going to be pretty good.
Yes.
I think it's going to be like Coke and Pepsi. Like maybe there are differences, but they're all really good, and they'll get better. And so right now they're as good as a grad student coming out of grad school, and that's true for an MBA. It's also true for a medical doctor. It's also true for a psychiatrist. It's also true for European history master's person. Anything you could get a graduate degree in, it can do that today. But it doesn't take action in the world, which is an agent. We have seen the first 2 or 3 attempts at that, and they're really damn good. Even though they're like cobbled together and a guy in his basement put it together. But the difference between an oracle and agent is it then takes instructions and it'll go out to a website and buy something on Amazon. It'll do actions for you.
It's more than, I mean, when you say instructions, I think that could be misinterpreted. It takes an order.
Takes an order,
a goal, right? You tell it to do something, and the how it gets done, you don't worry about.
Yeah.
It just goes off and does that thing.
And it doesn't care about that. It will try with a lot of dead ends. It'll try lots of things. But what's going to be interesting in healthcare is it can be like I could stand to lose 10 pounds. I could have an agent helping me lose 10 pounds, and it will try all different ways to get me to eat healthier, to exercise more, and it will keep trying until it figures out what works. And that will be brilliant because I don't know what works. It's hard. And that has just started.
Yeah.
And it's going to be a game changer. It's going to be really powerful. Let's talk about Health GPT.
Yeah,
that came out yesterday.
Yeah. So first of all, it's a project that's come out of Stanford. So the Stanford Biodesign for Digital Health. You can find them on GitHub, which is a repository where coders from around the world host their code in community where people can access it. They can read about it. They can clone it and do
Yeah.
their own work on it, et cetera, et cetera. So GitHub.
Yeah, so that's part of the reason this is going so quickly. Right?
Yes.
'Cause like that's at Stanford. Someone at MIT can take this without talking to anyone at Stanford, clone it.
Right.
Now they can build on it themselves, modify it, and then they put it back on Git. And then someone at, I don't know, Texas Austin adds on it. Then someone in Afghanistan takes it.
That's right.
Someone in China takes it. It's
There's
global.
no limits.
It's global. It's 24/7.
There's no
completely
limits.
open source.
Yep.
And incredible.
Yep. So they created Health GPT. So we already talked about how Stanford was able to clone a large language model based on open AI, and so we know that they've got strong capabilities. And Stanford is known forever as being just an incredible computer science institution. But Vic, like, say a little bit about Health GPT and sort of what it is, what the upside of it is, what the potential downside of it might be.
Yeah, so it is. It's the first instance where you can see the potential upside and the scariness of it, right? So it plugs into all Cardinals health packages and the Apple iWatch health kit, and builds on that, and you can share with it your health goals, and it will ask you for your health records, what you have experienced in the healthcare system. And the more you tell it, the more it is effective at helping you achieve your goals. And it's really damn good. And that's pretty interesting. And also, you are giving your data, your personal health data, but more what motivates you and what you believe in. So, are you religious? Do you get motivated by competition or rewards? You're giving that to OpenAI, and that is a lot of power. And so I'm not willing to give all of my health records to OpenAI. Not that I think they're going to do anything malicious with it, although they could.
Right.
It's because it's going to create lock-in. Like, if I start teaching OpenAI, I'm going to invest time, resources, data, teach it a bunch of things about Vic Gatto and what I care about, what I want to achieve. They have the ability then to increase prices almost unlimited. And I haven't trained Bard, which is Google's, or Anthropic, which is an independent one, or Stability, which is an open source one. And so I'm trying to get together a nonprofit to sort of just stand in the way and give me switching possibilities.
Right.
I don't mind OpenAI having my data, but I want to be able to take my data with me if I find a better solution.
Right. Kind of like Blue Button, right?
Yes. Yeah. I mean, I want to be able to get my data and quickly, but I don't want to get locked in. And this is going to lock you into OpenAI/Microsoft. And it's a great tool, but it was released 3 days ago.
Hold on. So released 3 days ago, has 1,300 stars. So that means that many developers basically have favorited it and are now getting updates on it. They're getting updates.
Yeah, right.
Well, it doesn't mean that they're using it, but like they're getting sort of updates on it. But I think the interesting thing is 112 forks.
Right.
So people are just grabbing the code and starting to do what they want to do with it, right?
Yeah. And what that means to me is there's going to be a Cambrian explosion of thousands of other things like this. And I want to be able to have portability.
Yeah.
Right. Like, I don't want to be locked in with one of the six.
Right.
But right now, you don't have that flexibility. So I'm not worried about necessarily AI destroying the planet and killing every human. I mean, there are people that are saying that. I'm not so scared about that as I am one early mover like OpenAI getting too much power. And now I have to spend another year and all this. Because it's a chat-based thing.
Yeah.
It asks you, like, has anyone in your family had cancer? And for me, I would say, yes, my dad had skin cancer. And so, okay, now I'm going to have to go through all of that same interview process again, even though I've already done it.
Yeah.
That's going to be a pain in the ass.
Well, it's just like the healthcare industry today.
It's like, exactly. Yeah, the damn clipboard. It's like an electronic clipboard.
Yeah. Every time you go to the same doctor,
Yes.
you have to fill
we
out
want to just make
everything on your
sure
clipboard.
you haven't changed your social security number.
But write it down.
Yeah.
Because that's secure.
Yes.
Yeah. So look, this thing is moving 1,000 miles an hour. It's not 100 miles an hour. This is just one of the implementations of it. But there are so many, I think, labor-oriented considerations, and not so much on the clinical side, because obviously there's a million regulatory roadblocks that will slow that. To me, it's more on the administrative side, right?
Yeah.
It's how many things, whether it's coding or anything revenue cycle management, related, or anything that has to do with procurement, right? I'm just thinking about all of the administrative aspects of healthcare that currently, people don't often think about the fact that healthcare is really collectively the largest employer, in the country. And it's not always a clinician, right? There's all these additional jobs that people are doing. And it's not the plumbers or the janitors who are going to be in trouble from this. It's anyone who is a quote unquote knowledge worker, and does things that really, when you extract what they're really doing, it's pattern-based operation of software. I mean, you have
it's replaceable.
It's super replaceable. It's super replaceable.
I write a monthly blog thing, and I titled it Hope. Came out yesterday, I think, or 2 days ago. Things move too quickly. But I think that healthcare has been, it's been picked on. It's been a hard place forever because it's hard work. And yet with AI coming, it's the safest place to be, I think, because, you have to put hands on the human eventually.
Yep.
And then I don't think AI is going to be good at empathy for a long time. And so the doctor sitting down with me and sort of talking through my cancer journey and listening to me, that's what humans need. And that sort of empathetic care from someone who has seen lots of people go through this, that's what I need as a human.
Yep.
The data of like all the clinical trials, all the therapeutic options, all the information, the doctor will never keep up with that. The AI will be much better. And that's what I want. But that frees the doctor now to, not be keying into the medical record, not having to read thousands of research papers every night, because that's not sustainable. And they can focus their care on actually caring for my fears, helping me navigate this. What do I tell my kids? What do I tell my family? How should we do this? I think healthcare people have been called to medicine to really help people with this journey. And if we can leverage it in the right way, AI will empower that.
Yeah.
And it could be great.
I agree with that.
There are other industries that I'm not sure that there's much empathy in being a financial trader on Wall Street.
No,
right? So
none.
They need to find some other way to add value. But I think there are other entire industries that will be replaced faster than healthcare. And so we've been worried about the labor force. And I think there's going to be huge numbers of people now that come into healthcare because they can make an impact and help people. And it could be really impactful. Yeah,
but I think you're talking about the clinical workforce again, right?
Yeah.
You're talking about people caring for people. And I guess what I'm saying is, as we approach this cliff of Medicare running out of money, as we approach just this year, the debt ceiling conversation, as we approach some real serious hard conversations about the deficit and us really needing to get our house in order as it pertains to that. And as we're talking about these operating margins that just do not make sense, right? But you can't make any money without the clinical workforce. There's a lot of quote unquote fat in the system that's on the administrative side. There's no question about this. There has to be a lot of fat that's there. And to me, I think there's going to be a lot of alignment around it's going to make sense to use AI to lower the total cost of care. And I'm not talking about paying clinicians less, right? I'm talking about making it less expensive to operate healthcare businesses, period. End of story, right? And
that's true, but every industry.
True about every industry, yes.
I mean, you can cut half the expense line.
Yeah, but not every industry is paid for half by the government.
Yeah.
Right, with a cliff that we've been talking about every single year that we have no idea how we're going to get out of it, right? So this, to me, feels like one of the first clues to how we might actually get out of that cliff. And it's hard to talk about because we're talking about a lot of people's jobs. But there's a cost issue here. I mean,
it's a lot of people's jobs, but they could do something that's more enjoyable, right? So I don't know a lot of people that love to sort of fight through the revenue cycle billing process. They do that in order to make money to have a life on the outside. And I think, we coming back to the payers are going to be faster at adopting this. And if the health system and providers don't get their act together on the administrative side, they're going to get killed on all the administrative side. And so it's coming. And I think the thing I'm hopeful about is the brand. The reason for, I need to learn the new name, Geisinger and Kaiser to be Risent.
Yeah, Risent.
The reason for Risent to exist as an entity in the world still is in place, right? There's a lot of other brands that I don't think exist in 5 years, 10 years. So there's hope that we can actually attract people, even if they're not clinicians. You need a lot of people. I think we need a person for each patient, helping them navigate the emotional journey that they have. There's a doctor,
but it's not a one-to-one. I mean, like the one person, if they can leverage AI, and if the patient is much more empowered through AI, right? You can have one person supporting how many individual patients? I mean, probably a pretty big number. I mean, the panel could be maybe even twice the size of it today.
Probably a big number.
Yeah.
But I think we're going to have excess people in society.
Oh, I get your point.
So,
I get your point.
If they're going to do nothing,
if they're going to do nothing, right?
We might as well have them help people
take care of somebody
at the lowest point in their life.
Yeah. Take care of somebody.
Take care of someone and hold their hand. Help them call their daughter. I mean, there are things that humans can do because they're human.
Yeah.
That I think is going to be hard to scale into AI. Yeah. And so I'm less worried about AI killing all of us, but I'm very worried about health systems and payers and everyone ignoring this. Right. And then there's going to be in this group of probably 4 people at Stanford that put it together. There's going to be other countries. The United States has to sort of lean into this.
Yeah.
But we're not going to be led by our politicians and our regulators.
No.
We're going to have to figure out how to do it ourselves. So hopefully in this podcast over the next little while, we can try to figure out where is the opportunity and how can we navigate this so it's fair to everyone.
All right. So that wraps up episode 1 of the Health Further podcast. And if you're watching this on YouTube, do the whole like, subscribe, share with a friend thing. If you are listening to it on iTunes, give us 5 stars and pass it along to a friend. Risks and disclaimers. None of this has been investment advice. This is just a good conversation between 2 friends who happen to work in the venture industry. Make your own decisions. Everything when it comes to investment is risky. Buyer beware and all that good stuff. And I think next week we're hoping to bring a conversation with Emily Evans, our friend from Hedgeye, who runs health policy. She makes us smarter every single week. So excited to have her with us. And sometimes we'll be in the office, sometimes we won't be in the same place, so we'll have to do it all sort of remotely. But we are going to strive to do this every week, right? We're committed to try to do this every single week.
Yes, because things are moving fast.
Yeah.
And it'll be fun to see how our perspectives change over time.
All right, awesome. Until next time, we'll see you.